Hello, this is Will Allen and Michael Brooks with Centera Capital. And today is the latest in our podcast series. We will be talking about the Federal Reserve and taking a look at their new projections for where Fed funds interest rates are going to be in the months to come. And we're also going to kind of take a look at the markets where they are right now, both stocks and bonds after the big sell-off we've had. And Michael, I guess we can kind of start with last week, Jerome Powell, another Fed press conference, another rate hike of 0.75%. But it was the projections for future hikes that really caught the markets off guard.
Yeah, I mean, everyone had expected the 75 basis point rise. That was right in line with where we had thought things would be. However, the tone of Powell has seemed to shift as of late, especially this last meeting where he seemed to come out with this very what some pundits are calling a tough love kind of message, where he's putting it pretty aggressive, saying, I hope you guys get the point here, markets, that we are raising rates. We will continue to do so until we see a couple of things change. But it seemed to be quite strong and quite hard language, and market participants did not like that. So it was more about his forward-looking projections, like you said, than necessarily anything that was surprising in the last couple of weeks.
Yeah, and I think our issue is that in June, mid-June, was the first Fed rate hike of 0.75%, right? That's the equivalent of 3 rate hikes. You know, in the past, the Fed tends to hike in 0.25% quarter point increments, right? And when he hiked in June by 0.75%, he specifically called out 2 things. One, gas prices. At the time, over $5 a gallon. And he said, look, inflation's out of control. Gas prices are a real problem. We want to see those come down. He also called out inflation expectations. He was very concerned that for consumers, that higher inflation kind of become embedded in the psyche of consumers. And he did not want that to happen. And there had been some polls and some indicators that had said, hey, consumers are starting to expect inflation's going to be higher for longer. But what's interesting is last week, when he had this tough love message, like you were saying, he basically said, hey, we haven't made any progress despite having 3 straight rate hikes of 0.75%. So we're going to have to continue to very aggressively hike rates, which is pretty surprising to me, given that, let's take a look at gas prices. In mid-June, it was over $5 per gallon nationally. Today, we're at $3.60 nationally.
Yeah, it's a big drop. I mean, we had very precipitous prices rise very short period of time, but they've gone way down in the last couple of months since the height of the summer. And in the summer, we thought there may have been, real big problems as we were entering in with such a high gas price rate. But it seemed to fall all throughout the summer and to where we are today.
Well, and the gasoline futures have fallen basically another 40 or 50 cents a gallon, which that typically predicts what gasoline prices at the pump are going to be 3 or 4 weeks in the future. So it's possible gas prices could go down more. Oil is down to $77, $78 a barrel. It was at $125 a barrel in mid-June. And it's not just that. Let's look at lumber. Lumber prices are down 70% from the spring. 70. Don't forget that in 2021, some of the first indicators we had a major inflation problem was lumber, freight cost, We all remember all the ships, port backing out in LA, right? Um, well, freight costs are down 60%. Used car prices are down 4 straight months. Copper down 35%, steel down 35%, wheat 33%. Look, inflation is not solved, but we have had some very aggressive rate hikes over the last 6, 7 months, which is good. They were needed. But it just floors me that Powell did not acknowledge any of that last week in his press conference.
Yeah, he just stood firm. It seemed like he was, I mean, to us, it seems like he's looking at data from months ago and just saying that there has been no progress is obviously not right. So there's some kind of psychology that's going into this, I think. I mean, we're gonna see what the next couple of months holds for us. We definitely know that there are a couple of rate hikes on the table still. The size of those we're not completely sure of yet. No one knows. But yeah, let's see what those expectations are. You got a chart.
Yeah, a couple charts to show the folks here. This is from our blog post last Friday. Hawkish Powell rattles markets, and the reason we want to kind of show this one more time is in June when Powell hiked by 0.75%, and he called out two things: gas prices and then inflation expectations. And this is from the New York Fed. It's basically, what does the US consumer, where do they think inflation is going to be over the next 3 years? And you can see that this has had a precipitous decline over the last 3 or 4 months. This peaked, by the way, in late 2021 at 4.2%. But it was it was hanging just under 4% in June. It's down to 2.76. That's kind of back in line with where expectations were in 2018, 19, 20, back when we did not have any inflation issues.
Or COVID.
Yeah,
Or
I mean that's
COVID. That's
yeah,
before COVID. We're getting
pre-COVID.
back to, yeah, pre-COVID times, right?
Exactly. And so that is a sentiment survey. We also have, I'll pull up this. This is a 5-year break-even inflation rate. This is investors. I won't go into the mathematics behind this, but the point is this goes back to 2018. This is, what do investors foresee in the next 5 years as far as inflation goes. This peaked in late March at 3.6% here. Take a look at this. This is a steady decline. It is at 2.35% currently. That's as of yesterday. Again, not quite back in the range where we typically saw it in 2015, 2020, and that kind of time frame. That was between kind of 1.5% and 2%, but it's down significantly. And when you put both of those together, I guess the point is that tells us inflation expectations have not become entrenched in the mind of consumers. So by Powell's own criteria in June, he should be pretty pleased with that.
Yeah, I mean, we're definitely not facing the question of peak inflation at this point. I mean, we've gone way past that, obviously, with, like you said, all these things that have shown big falls. So with the top line number there is, we really hope that we're going to get to see some better numbers in October, but I really don't think that with all that we've seen, though some of those things had to catch up a little bit. August was not great, but when we have September numbers come out in October, we're gonna have a couple of different things there of data points for us to point to. We would really hope to see that thing has fallen pretty sharply.
Well, and let's again set up for folks, I think, what's in front of the Fed here. Let me show another chart here. And this is 30-year mortgage rates. This was very notable yesterday. The rate on a 30-year mortgage crossed over 7% for the first time since 2007. As a reminder, mortgage rates were 3% coming into the year. So rates have gone from 3 to 7. And every contact that you and I have talked to, the contacts of ours in the real estate field, has told us that in the last 2 to 3 months, there has been a switch flipped in the real estate market, a bucket of ice water dumped on the housing market, which is what the Fed wanted, by the way. Again, they called out all along, they don't want home prices going up 20% a year. That's not sustainable. But again, we're now at 7% on mortgage rates, and this is having a major chilling effect. Mortgage applications last week were at their lowest level since 1999. And if you also take a look at home prices, and can you see this chart, by the
Yep.
way?
Yep.
Okay.
Yep. We can see it.
So for people to understand, this is home prices month over month over the last 10 years. Look at this fall. We have the largest month over month decline in prices in over 10 years. And this was at a time when mortgage rates were at about 5.75. In real time right now, with mortgage rates hitting 7, this is going to fall further. And so for the Fed, you're sitting there, and like you said earlier in the podcast, is the Fed just looking back? Home prices yesterday were up 16% year over year. Okay. They had been running at 20% year over year. So you look at that and you say, hey, 16% is still too much. And yes, it is. But that accounts for all the increase that took place last year, earlier this year. In real time, prices are now falling. And so if you're the Fed, you say, hey, look, prices are now falling for the first time in 10 years significantly. And this is what we want. But they also could look at it and say, hey, prices are still up 16%. We have further to go. I think that's a mistake, because I think in real time, they're getting what they wanted. They're getting the housing market cooling. What's your thoughts on that?
Yeah, absolutely. One thing I remember, can you remember you had gone back, you had said something about the dollar amount to me before. Let's tell them there's something about $1,000 a month. That's the average home price. Is that correct? And what the
Yeah.
7% effect is in dollars.
Yeah. So if you take the price, the median home that is sold currently, just by the increase in a mortgage going from 3% to over 7%, that is over $1,000. It's closer to $1,200 a month in an increased mortgage payment, just based off that mortgage
Just the
rate being
interest.
higher. Not
Right.
even counting home prices have also grown over last year. That's almost $1,200 a month for the average household. They can't afford that.
No. So that is going to dry up. Powell should be getting what he wants. Job market should be interesting to look at. We haven't seen too much changes there, except for a couple of maybe some positive news on the job front. Is there anything you can mention there?
Yeah. We did get, for the first time, one of the big problems in the labor market, and everybody knows this, if you go to a restaurant or you go on a trip or you go to a business, you see a lot of help wanted signs, right? A lot of people can't find enough workers. Last month, we had a pickup in the labor force participation rate. So that's people who are coming back and say, I'm now looking for work again. A lot of people have been on the sidelines. We had over 700,000 people come back into the labor force last month. The first time we've had a number anywhere close to that high. Hopefully, that is not a one-off. Hopefully, we see that again in the upcoming reports, because that will really help businesses and the wage pressures. If all of a sudden we start getting 5, 6, 700,000 people per month coming back into the labor force, that will make Powell's job much, much easier.
Great. And just one last I have actually a slide here
Yeah.
for us. And
Yeah.
let me
Pull
just
it
share
up.
this one real quick here.
Yep.
But basically what we've got right here, just to give you some transition into our talk about inflation, going into, the market, the stock market reactions, and where we might see things go from here. But if we take a look at this chart goes all the way back to 1970, and we're looking at the S&P 500, top 500 stocks in the market index that most people watch here, and we're looking all the way back to 1970 and the effect of market prices on really bad reactions to an inflation reading. So if we take the 10 kind of worst periods of a market reaction, meaning that the stock market falls pretty precipitously, and then what does the market do after this time? Barring the two financial crises that we had in the tech bubble and the financial crisis in 2008, 2009, except for that one where pretty much stocks were about flat, we have very strong rises in every period after this. So this is not to say that we're calling for 400% increase guaranteed. No, we're not doing that. We're not trying to predict or time any markets. We're just saying that if you have these big falls, you have inflation reactions very negative. We could see definitely in the months to years to come, setting up for some really good returns in the future. What do you think?
Yeah, I think that's a good chart. That's very interesting to see, and that segues also into a couple other charts here, based on kind of where the markets are right now. Um, we have seen perhaps the biggest news of the year, I think, in terms of the bond market, is we are basically at unparalleled declines in bonds year to date. What you see in front of you here is the Barclays Aggregate Bond Index, which is basically the S&P 500 or the Dow Jones Industrial Average of the bond market, is year to date now down over 15%. Now, to put that in context, going back to the mid 70s, the bond market's only been down 4 years, only 4 calendar years. And the worst decline of those 4 was 2.9%. You're talking about a loss of 15% so far. That is 5 times the worst calendar year loss. So this is pretty much unprecedented for the bond market. Also on this chart, investment grade corporate bonds. These are companies that there's almost no risk of default. So your Apples, your Walmarts, your Coca-Colas, down 22%. And lastly, 20 and 30-year U.S. government bonds, treasury bonds, down 31% year to date. Those are shocking losses. What that has led to right now for us as managing client portfolios, either in the ETFs we own for clients, the bond ETFs, or some of the individual bonds we've been buying, is that now much higher interest rate yielding bonds are available because of these declines. So now we're seeing 4, 5, 6% rates of return for upcoming years due to these declines. For the last 15 years or so, I mean, you have to go back to 2007 since you saw these kind of rates. Most of the time for the last 15 years, interest rates were 1, 2%. It was nothing to get excited about. but you have now a really great opportunity in the bond market after this major sell-off. Now, also, uh, let's talk about the fact the stock market is down for 6 straight days. And so we wanted to give people an idea. This is year to date. This is called the CBOE Volatility Index, it's known as the VIX. This spikes when volatility picks up. I put 4 of these circles here. And the first 3 are times this year when this number got to 34 or higher, which, by the way, today this came right up to 35. Okay. But 3 times we've been to 34 this year. And right here are these 3 occasions. And you can see the 3 previous occasions when the VIX hit 34, we had rallies. The S&P on average gained almost 10% in the weeks following the VIX hitting 34, and the NASDAQ was up 13.5% on average the last 3 times. And the idea behind this is that you have a lot of fear, a lot of panic in the market, and often that means the market becomes short-term oversold, and you have these really strong rallies. Now, again, like you said earlier when you were showing that CPI chart, that is not us predicting what the market's going to do in the short term, but you have at this point almost unprecedented levels of pessimism. Another chart, we won't show it because we've shown enough here, but there is a sentiment indicator, a poll done, it's called Bulls and Bears, and it hit its highest levels of bears relative to the bulls going back to 1970, with the exception of 1 week in 2009. It was the week the stock market bottomed from the financial crisis. So the stock market was down 55%. You had had a very deep recession at that time. That week is the only time in the last 60 years that investors have been more bearish than they are right now.
Which, to sum that up, just means when we see sentiment go that far and that extreme, this is a very big flag indicator for us that things could be going the opposite direction. I mean, when there's excessive fear or there's excessive greed, we could take advantage of this. We see this all the time in markets, and we're really coming up upon, we've got to think that the future looks a little brighter, given all that has been thrown at markets this year. We know all that's going on with interest rate, what the Fed's doing, what Russia's doing, what gas prices. We have all this data now, and we just have to let markets work themselves out here, I think, in the next couple of months to a year.
Yeah, I agree. And one of the things that also is coming up in play here is that historically, the second half of August and then September and the first half of October is seasonally the toughest periods of the year for stock markets.
Yeah, don't
But
remind
normally
me
the
of
second
September
half of
2008.
October through January is
Right.
seasonally the best time of the year for markets. And again, like you said, we're not making any, pronouncements that the market is bottom and is now soaring. But what we are saying is, when we see this much fear, we typically, if you look out 6 months to a year, you have higher than normal returns for the stock market.
Right.
And one thing that's going to also happen in mid-October, we're going to start getting earnings. And I can't stress enough that ultimately, in the long run, that's what matters most for the prices of stocks. Where do earnings go? Because so far, right now, earnings are expected to grow in 2022 by about 8% profits for the S&P 500. At the start of the year, before Russia invaded Ukraine, before China did their lockdowns, before inflation hit, 9.5%, all the other issues we've had, earnings were expected to grow about 8%. So you have had virtually very little change. And so if company earnings can hold up, I mean, markets bottomed in mid-June. Okay. We had a nice rally in July and early August. And a lot of that was because earnings were a lot better than to be expected at that time. If we get that again, that certainly could power a nice rally in October and early November.
Great. Well, we would hope, we would cross our fingers, but again, we're here for the long haul.
Yep.
Long-term markets. This is going to work itself out, and I think we're going to have hopefully some reprieve from some of this nasty, nasty year so far. But these things happen. We haven't had a big drawdown like this since. Oh wait, it was recently. It was COVID. We were down 32%, and now we have another one. But this is all kind of wrapped up in the same concept here. We hope to get through this pretty well in the next couple of months to a year.
Yep. Well, thank you all for joining us. We'll continue to keep you updated and continue to manage your portfolios. Take care.
Take care.